Banks are like the guardians of our money. They provide a secure place to store our funds, ensuring that our savings are protected from theft, loss, or damage. We entrust them with our hard-earned savings, knowing they will keep it safe. This trust is built on years of reliability and the assurance that our money is in good hands. But banks are more than just glorified piggy banks. They are complex institutions that offer a wide range of financial services, from savings accounts to investment opportunities. They play a vital role in the economy, acting as intermediaries between savers and borrowers. This means they help channel funds from those who have surplus money to those who need it for various purposes. Think of it like this: you have some extra cash you don't need right now. Instead of letting it sit idle, you can put it to work. You could stuff it under your mattress, but that wouldn't be very smart. Not only is it unsafe, but it also doesn't earn any interest. Instead, you deposit it in a bank knowing it's safe and sound. Plus, the bank pays you interest, so your money grows over time. Now let's say someone else needs money to buy a house or start a business. They don't have the funds readily available, but they have a solid plan and the ability to repay a loan. They can go to the bank and apply for a loan. The bank evaluates their creditworthiness and the feasibility of their plan before approving the loan. The bank uses the money you deposited, along with money from other depositors, to make that loan. This way, your idle money is put to productive use, helping others achieve their goals. That's the basic idea behind banking, connecting those who have money with those who need it. This system supports economic growth and stability by ensuring that resources are efficiently allocated. It's a simple concept, but it has profound implications for how our economy functions. By facilitating the flow of money, banks help drive innovation, create jobs, and improve living standards for everyone. Banks perform three core functions: accepting deposits, making loans, and processing payments. These functions are the foundation of the banking system and are crucial for the smooth operation of the economy. Without these services, the financial system would come to a halt, affecting businesses and individuals alike. These functions are interconnected and essential for a healthy economy. Deposits provide the necessary funds for banks to offer loans, and loans, in turn, stimulate economic activity by enabling businesses to expand and individuals to make significant purchases. Deposits are the lifeblood of banks. When customers deposit their money, they trust the bank to keep it safe and to provide access to it when needed. This trust is fundamental to the banking relationship. They provide the funds that banks use to make loans. Without deposits, banks would not have the capital required to lend money to businesses and individuals, which would stifle economic growth. When you deposit money into a bank account, you're essentially lending that money to the bank. The bank then uses these funds to provide loans to other customers, charging interest on these loans to generate revenue. In return, the bank promises to keep your money safe and to pay you interest. This interest is a small percentage of the amount you have deposited, and it serves as an incentive for you to keep your money in the bank. Loans are the flip side of deposits. When banks make loans, they are providing the necessary capital for individuals to buy homes, start businesses, or invest in education. When banks make loans, they're essentially creating new money. This is because the money they lend out doesn't disappear from the economy. It's simply transferred from the borrower's account to the recipient's account, facilitating economic transactions. This is because the money they lend out doesn't disappear from the economy. It's simply transferred from the borrower's account to the recipient's account. This process helps to keep the economy dynamic and fluid. Payments are the glue that holds the economy together. They enable the transfer of money for goods and services, ensuring that businesses can operate and individuals can meet their financial obligations. Banks facilitate payments by transferring money between accounts. This can be done through various methods, including electronic funds transfers, checks, and online banking. Whether you're paying your rent, buying groceries, or receiving your salary, chances are a bank is involved in the process. This seamless transfer of money is what keeps the economy functioning smoothly, allowing for the continuous flow of commerce and trade. Here's where things get interesting. Fractional reserve banking is a fundamental concept in modern finance, yet it remains a mystery to many. Let's dive deeper into how it works and why it's so crucial to our economy. Banks don't actually keep all of your deposits in their vaults. Instead, they only keep a portion of the total deposits on hand, which is why it's called fractional reserve banking. This system allows banks to use the rest of the money to generate loans and investments. They only keep a fraction of deposits on hand. hence the term fractional reserve banking. This fraction is determined by the reserve requirement, which is a regulation set by the central bank. The fraction of deposits that banks are required to hold in reserve is known as the reserve requirement. This requirement ensures that banks have enough liquidity to meet the withdrawal demands of their customers. The reserve requirement is set by the central bank, which is like the bank for banks. The central bank uses this tool to control the money supply and maintain financial stability in the economy. So, what happens to the rest of the money? The money that isn't held in reserve is lent out to other customers, which helps stimulate economic activity. Banks lend it out to other customers. These loans can be used for various purposes such as buying a home, starting a business, or funding education. And when those customers deposit the money they borrowed, the cycle starts all over again. This continuous cycle of lending and depositing is what keeps the banking system dynamic and fluid. This process is known as the money multiplier effect. It essentially means that the initial deposit can lead to a much larger increase in the total money supply. Let's say you deposit $100 into your bank account. If the reserve requirement is 10%, the bank is only required to keep $10 of your deposit in reserve. If the reserve requirement is 10%, the bank is only required to keep $10 of your deposit in reserve. The remaining $90 can be lent out to another customer, who might then deposit it into their own bank account. The bank can then lend out the remaining $90 to another customer. This customer might use the loan for various purposes such as purchasing goods or investing in a business. That customer might then deposit the $90 into their own bank account. Their bank can then lend out a portion of that deposit, continuing the cycle. Their bank can then lend out $81 of that deposit, and so on. This process of relending and redepositing continues, amplifying the initial deposit. This process can continue until the initial $100 deposit has created up to $1,000 in new money. This is the power of the money multiplier effect, which plays a crucial role in expanding the economy and facilitating growth. The money multiplier effect might sound like magic, but it's actually a simple mathematical concept. It's all based on the idea that banks can create money by lending out a portion of their deposits. This process of creating money through lending is essential for economic growth. When banks make loans, they're injecting new money into the economy. This new money can be used to finance businesses, buy homes, and create jobs. Without banks and the fractional reserve system, our economy would be much smaller and less dynamic. Section 5, Fort Knox 2.0, Safeguarding Your Money, Risk and Security in Banking. Of course, lending money is not without its risks. Borrowers may default on their loans, meaning they don't repay the money they borrowed. This can lead to losses for banks. To manage these risks, banks have sophisticated risk management systems in place. They carefully assess the creditworthiness of borrowers before making loans. They also diversify their loan portfolios, meaning they lend money to a variety of borrowers in different industries and geographic locations. Banks also go to great lengths to protect your money from theft and fraud. They use a variety of security measures, including encryption, firewalls, and fraud detection systems. They also educate their customers about how to protect themselves from scams and identity theft. Section 6. In banks we trust, the invisible hand that underpins our financial system. Trust is the bedrock of the banking system. Banks rely on the trust of their depositors. Depositors need to trust that their money is safe and that the bank will be able to repay their deposits when they need them. This trust is built on a number of factors, including the bank's reputation, its financial strength, and the regulatory framework in which it operates. Governments play a crucial role in maintaining trust in the banking system by regulating banks and providing deposit insurance. When trust in the banking system is shaken, the consequences can be severe. Bank runs, where depositors rush to withdraw their money all at once, can cripple banks and even bring down entire economies. Section 7. The digital disruption Fintech on the rise, a new era for banking. The banking industry is undergoing a period of rapid change. The rise of digital banking and financial technology, or Fintech, is transforming how we bank and manage our finances. Online banking, mobile payments, and peer-to-peer lending are just a few examples of how technology is disrupting traditional banking. These innovations are making banking more convenient, accessible, and affordable for consumers. However, the rise of fintech also presents challenges for traditional banks. Fintech companies are often more agile and innovative than their traditional counterparts. They are also not subject to the same regulations as banks, which gives them a competitive advantage. Section 8. The Unsung Heroes. How banks keep the economy humming. Banks play a vital role in our economy, even if we don't always realize it. They connect savers with borrowers, facilitate payments, and create money through lending. Without banks, our economy would grind to a halt. Businesses wouldn't be able to get loans to invest and grow, consumers wouldn't be able to buy homes or cars, and our overall standard of living would be much lower. Despite the challenges they face, banks are likely to remain a cornerstone of our economy for many years to come. Section 9. Conclusion. The enduring relevance of banks in a tech-driven world. The banking industry is evolving rapidly, driven by technological advancements and changing consumer behavior. However, the fundamental role of banks in the economy remains unchanged. They are still the custodians of our savings, the facilitators of our payments, and the engines of economic growth. As we navigate the increasingly complex world of finance, understanding how banks work is more critical than ever. The future of banking may look different from its past, but one thing is certain: banks will continue to play a vital role in shaping our economic landscape.